Coming to you from the Tar Heel State, this is the Carolina Commercial Real Estate Connection, bringing you industry insights and hot takes from Carolina real estate experts, helping you begin, grow, and scale your commercial real estate portfolio. And now your hosts, Tony Johnson and Cameron Pearson.
Welcome back to another episode of Carolina Commercial Real Estate Connection. Today we have Amanda Cruise with Voyage Investing. Amanda, thank you so much for joining us.
Yeah, thanks, Tony. Thanks, Cameron.
So Amanda, tell us a little bit about yourself, how long you've been involved in real estate and what you're up to.
Yeah, so let's see. I got into real estate in 2018. Coming out of a W-2 career, sort of a very traditional upbringing. I went to undergrad and then I got a master's degree and was doing analysis for the Department of Defense, and then later jumped over to Capital One and was doing sort of financial analysis for them, managing a team of analysts there, and really wanted to build something for myself. So in 2018, my husband, Jonathan, and I started in real estate. We bought a duplex and we fixed that up and we got tenants in place. And then we did a couple of other sort of single family bird deals, that sort of thing. And we knew our ultimate goal was to actually leave W-2 jobs. So buying a couple of single families and burying them a couple times a year wasn't going to cut that. So we ended up doing a couple of individual mobile home deals where we bought them and then we turned around and sold them, and we were the bank. We carried those notes and those turned out to be good for us. So that took us into mobile home parks, or we own a handful of mobile home parks now, and we're continuing in the commercial real estate path today.
Amazing. So I did not know this, that you were an analyst for the Department of Defense. How long were you doing that?
Oh man, I don't know, maybe almost 5 years, something like that. We were doing wargaming analysis for the Navy.
Holy moly. Wow. That's amazing. That's awesome.
Yeah. It sounds way more fun than it actually is. Right. I tell people it's like the most boring video game you've ever played.
Yeah. Oh, I was all excited. Yeah. So now it's boring. I was about to ramp this thing right up into that.
Would you like to play a game?
That's right.
All right. Well, that's great. All right. So you got started with a duplex, did some single family deals. So one of the things that you brought up is then you bought some mobile home parks and you sold them and carried the notes. So how did that go? Are you still doing that? Are you continuing doing any of that?
We bought individual mobile homes back around 2019 or so. We were buying individual mobile homes before we ever bought our first park. It went really well for us. And that, so we'd buy a home, let's say for like $15,000, and then we would turn around and sell it for $25,000, and we would just carry the note portion. And so those notes we put at 18% interest, low money to get into it. You're getting a good return. And so really learning and doing that a couple of times was a good kind of understanding of notes and all the different pieces of real estate. And it got us a good understanding of how mobile homes and mobile home parks work. And we knew we wanted to go bigger. Again, these were small dollar amounts, so we were ready to scale to something bigger. And that's when we got into the parks.
And when you sold them for the 25 versus the 15, did you do upfits to them? What did you do to make them that value?
Was the best part about that strategy. Nothing. You don't do anything. You just buy it.
Zero. We did zero.
Sign me up for that. I like the nothing.
To be fair, there was one house that had evidence of prior termites. So we did do a termite treatment underneath before. And there's one horror story of fleas all in a house that we ended up having to spend like 6 weeks with doing all these flea treatments. But, going in, we weren't flipping them. We weren't renovating them. If there was something that needed to be done for it to sell and us to feel good about selling it, we would do that. But otherwise we were open about, it is what it is. We're not going to fix carpet or cabinets because we're selling it for, $20,000 or $25,000. It wasn't like we were selling this remodeled home.
That was with land as well.
No, this is individual homes in a park. So they would pay us a
Gotcha.
mortgage payment, and then they'd pay lot rent to the park owner.
That's great.
So you were buying them and paying the park rent until you sold them.
Exactly. Yep. It's kind of a fun little game there. You try to do
Yeah,
it with
that
just
is
1 month's lot rent out of pocket.
Yeah, that's not a bad low barrier of entry type of way to get into real estate. I mean, that is very cost effective for somebody that doesn't have a lot of initial capital to get in and get involved, get a good understanding, and then, dealing on the lender side of it, doing notes, I mean, really you're learning a lot of different aspects at a low cost of entry. That was a great creative way for you and your husband to get involved.
Yeah, it taught us a lot.
So once you got involved a little bit, tell us a little bit more. So then you got into purchasing a couple mobile home parks. Am I right?
Yeah. So in 2020, we bought our first mobile home park in the first week of April of 2020. So that was obviously terrifying. We went under contract in January. The whole world changed, and it was the biggest investment we had ever made. So we were terrified, and I'm the one who does the numbers. So I ran those numbers like 100 times. But it made sense. We are getting 50 lots for $590,000. Half of the park could have not paid, and we would still be able to make our mortgage payments. So like the fundamentals were there. It's in a good area. So we moved forward with that one. We currently own 4 parks. We're about to close on a 5th one next week. So I think we'll be at around 130 lots, something like that, after we close next week.
Fantastic. And so what type of returns are you seeing in mobile home parks?
Okay. I'll answer that a few different ways. Everyone says, hey, mobile home parks are cash cows, right? And everyone kind of wants to go from multifamily to mobile home parks chasing yield. So yes, outright, you can get a higher cap rate traditionally when you buy a mobile home park than a multifamily asset. So on day one, your returns are higher for that net operating income that's coming in, right? Now, you also have to buy right, because a lot of people have not been buying right as they've gotten more and more aggressive in the mobile home park space. I see assets going for way too much money, especially when they have park-owned homes that really shouldn't be capitalized. And there's all sorts of stuff going on with the pricing of mobile home parks. So you're not just going to walk in and guarantee yourself money. There's also risk in the infrastructure that you really have to understand in order to make sure that you are cash flowing well. But that being said, you can make good money. There are a lot of value add opportunities. We have bird, right, our parks. So when we made them worth more money, then we take our money back out and they're still cash flowing. So we've done that on some of our parks. And, at that point, obviously it's an infinite return, but you can essentially go in and expect for a really, really awesome park that's larger with city infrastructure in a big MSA, you might be paying in the low 6 caps even today. Or if it's kind of a crappy park in a tertiary market that has well and septic, you might see those for 12 caps if they're park owned homes. So there's a pretty wide variety in what you're going to get.
Okay, perfect. Now, for people that are not in the mobile home space, when you say park owned homes, not park-owned homes. So can you run us down the difference in that and why that matters?
Yeah, absolutely. So there are really 2 different types of ways to manage a park. You can own the homes and the park itself. The park itself meaning the infrastructure, the roads, the water lines, the sewer lines, right? So you can own that park infrastructure and you can own the homes. In that case, you just have standard rentals. You're renting them out just like they were single family houses. Then on the other side, you have tenant owned homes. And that is where you own that land, that infrastructure, the roads, the water, the sewer, all that stuff, but you do not actually own the homes themselves. Residents own their own homes and they are paying you lot rent for the right to keep their home connected to your infrastructure. You have some parks that are all tenant owned, some parks that are all park owned, and a lot of parks that have sort of a mixture of the two.
Absolutely. So when you go into looking at mobile home parks, there are advantages in not having to own the homes because you have the advantage of not having to deal with all of the problems with the mobile homes themselves. Are there disadvantages of not owning the mobile homes?
Yes. Okay. So you are spot on that it's more streamlined, right? You don't have to do paint and carpet and toilets and all that stuff if you do not own the homes. Now, on the flip side, it really depends on what your goals are. There are two reasons I would say you might want park-owned homes. The first is if you don't want to scale. You really want to own maybe a couple of parks, or you just want to manage it yourself, and it's okay that you have more work to do because you're making more income. So you may rent that park-owned home for $1,000 a month instead of the lot rent for $300. Now you're going to have extra expenses, but not $700 a month worth of extra expenses. So you're still going to make more money, but it's more work. A lot of people are totally fine with that. The other way that park-owned homes, I like them, is if you're going to kind of flip something quickly. So if you don't really care about holding on to the asset in the long term, a lot of brokers right now, like every broker, they're capitalizing the full income of the park, regardless if they're park-owned or tenant-owned. So that income is higher when you have that park-owned home income. So if you really are just looking to kind of sell quickly and get out, the most money you're going to sell your park for is if you do have these park-owned homes.
Yep. That's a good point. So obviously with a park owned homes, you're going to show more profit. So then you're going to be able to demand more dollars. So yes, it's less work, less maintenance, obviously, and oversight when you just are owning the land and infrastructure and doing tenant rent. But then, of course, when you're selling it, you don't own the mobile homes. It's less appealing to sell. So it has, I guess it's obviously less maintenance, but then you have less profit. So yeah, I understand where you can look at it both ways. Another thing that you mentioned, let's say if we're just buying the park itself and all the tenants own their own mobile homes, there are risks in infrastructure, you stated. Could you run some of the risks in infrastructure that you run into?
Yeah, so infrastructure is key in a mobile home park. It's really what makes that park more valuable than land. So having that water line, that sewer line, the electrical connections, those are critical. Now, some parks will have really old systems. Some parks will have, let's say, wastewater treatment plants or lagoons, which means on-site handling of the sewage. You don't want that. You don't want to buy a park like that. They're very hard to sell. Nobody else wants them either. So even if you're getting a decent price for the park, you still take on that risk. Let's say your wastewater treatment plant fails. These things are monitored by the government. So if it fails, you may be looking at a $400,000 fix. Well, a park that you bought for $1 million can't absorb a $400,000 fix, most likely. So you could really be like up a creek there. And so really understanding what you're purchasing and not taking on too much risk with older systems or wells that, for instance, aren't being tested right, or they're too shallow. Those things can really mess up a park if you can't just connect to a water line right out front, for instance, and you're stuck having to drill another well, or, like $10,000 each time you try to go drill. So these things can get really expensive quickly.
Do you, so when you're looking at these as an opportunity, do you get them under contract and then go dig into these details, or do you try to get as much as that upfront before you even make the offer?
Oh, that's such a good question. We try to understand the high level before we even make an offer because it matters in our offer price. So for instance, if it's well and septic, depending on the location, I may not even want it myself. We may be looking at it at a certain price, just knowing I might go assign it to somebody else who's more comfortable with well and septic. Whereas if it is septic and city water in a decent location, yeah, I want that park. So then I really want to understand way more about how many tenant-owned homes, how many park-owned homes. Like I need to underwrite it in a lot more detail in that case. And also just as far as the returns, the risks, how much am I going to set aside for septic maintenance? All these things come into play on the financial side. So we always have a conversation with the sellers and really trying to understand as much as possible about the parks before we're even making an offer.
And I would assume, and tell me if I'm right or wrong, and if you could elaborate, when you're looking at mobile home parks, it's not like looking at a retail strip center. You want to be in a great area with high traffic. What are you looking for in a mobile home? I mean, when you're saying that you can get at a 12 cap in tertiary markets or somewhere out in the middle of nowhere, I mean, that seems appealing. I mean, I guess the mobile homes are probably not moving a lot in those areas. So you're going to have tenants that are sticky, right?
Yeah, so that's true, but you do want to be careful of the area. Like if a broker lists a park at a 12 cap, I highly doubt that I want it because that's a super risky park. Like I would want to go in and get it at like an 18 cap, right? So you still want to be in a good area. Now you're not right in the center of town. You don't want a bunch of traffic driving past the park necessarily like you do with a retail center, but you want to be in an MSA that has diversified jobs, that is a steady population or growing. You don't want to have a declining population, right? So as long as you have a median household income, so let's say if a typical house sells for $100,000 in an MSA, that would not be ideal for a mobile home park, even though you may have plenty of tenants, but they can go buy a house for so cheap that your offering isn't that great. Whereas if you go to an MSA where your average home is selling for $200,000 or more, now it's going to be really hard for them to go buy a house and compete with you. So that's going to make what you're offering just a lot more valuable.
That makes them a lot stickier. I guess.
Yeah.
So yeah, obviously, yeah, that's a great point and a great way to look at it. So when you're looking at these, and let's say you're looking at the infrastructure and seeing how on a value add basis you guys can create value, with multifamily, you're adding dog parks and other little attributes like that. What do you guys look as a value add opportunity on some of these parks?
Yeah, I look at value add in kind of two different ways. The more concrete P&L side, right? We're increasing the net operating income. So just like in multifamily, we can bill back water. We can make sure the rents are at market value. We can make sure we're not overpaying for a manager, right? Anything we can do to truly maximize the NOI, we can go and do. Now, on the sort of softer side, we can improve the infrastructure. We can make the park look nicer because these things help it sell for a lower cap rate one day or be more attractive to potential buyers if they can come in and have a park that already has a manager with online rent collection. Then it's easier to sell. There's a bigger buyer pool. So that's also going to make the park worth more money in the long run, even though you're not actually impacting the net operating income. So I sort of look at both of those pieces.
And do you build relationships with mobile home builders so that you would have, if you found a park that had pads available, you're going to be able to, are you finding used mobile homes or are you going to put in new?
We are now dealers. So we work directly with the manufacturers because they can give us the dealer price on them. And then we'll move new homes into the park and get them set up and sell them.
Cool.
We're actually just starting to go down more of that path. Right now we have 3 different parks we're infilling, but just, 5 or so lots per park. Once we get that sort of systematized and really can underwrite the financials of that better, then I want to do a bigger infill. So maybe next year we'll try that.
Yeah, I think that would be fantastic once you systemize that. If you can get that and you've got, developable pads or you've got pad readies where you can add more, I'm assuming, you can control and really start pushing values up easily doing that, especially if there's demand.
Yeah. So the idea is you can work with these third-party companies, right? Like 21st Mortgage or Triad, and you can buy the homes directly from a manufacturer and the third-party company will actually pay for the home. So you're not out of pocket anything there. You pay for the setup costs, like $17,000 to get the decking and the skirting and the HVAC hookups, the electrical, all that stuff, right? And then you sell it with an all-in cost. So let's say it's $45,000 to buy it, another $20,000 to get it ready, and then you put a little bit on top. So let's say you sell it for $70,000 just to make sure you're breaking even. Well, then you have broken even getting a new home into your park that's paying you lot rent. So you've added value to your park and you're not out any money. So that's the game you're really trying to play with these infills.
Now, is there a challenge? I know you're saying the mortgage where you're buying them, the end buyer, are they able to get mortgages on these? How does that work? I know there's been a challenge, I thought, in the past with them being able to get loans on the mobile homes. Is that still the case, or are there options?
Yeah, so there are more options now, but you're not going to go to your standard bank where you would go finance a stick-built house. There are specific companies like 21st Mortgage and Triad. They're set up specifically to finance mobile homes. In parks is totally fine. And so these companies may only require 5 or 10% down. They are going to be higher interest rates than you're going to pay, if you go to Bank of America or Truist or something like that. But it does allow residents to buy the homes and finance them through that third party, and then they're just paying us lot rent.
When you're getting tenants in this in the mobile home market, how is the delinquency rate compared to standard rentals?
Interestingly enough, so let's say we bought our first park in 2020. That maybe at the beginning was bad timing for delinquency, although we never had any delinquency for like the first.
That's terrible timing for the delinquency.
Yeah. Well, actually, it was kind of perfect, right? Because that's when the government started printing money and throwing it at people. So we didn't have anybody evicted for the first 2 years that we owned our parks. People were paying. Now we're starting to see some amount of delinquency, but we're really, really low, like even less than 5% on an average vacancy. Like we do have to remove a couple of tenants every year for non-payment or because they sold their home to somebody who would not qualify to live in the park or who knows what. But overall, I find it's a lot lower of a vacancy rate than you would have in multifamily because you do have that lower turnover, particularly with the tenant-owned homes.
That's great. I mean, this is a really good niche, and you are definitely well versed in it. It seems like, you will be very successful continuing this. And I think if you stay focused on something like this, it really has the opportunity to go up. Now, as you mentioned in the beginning too, this has become, back 10 years ago, people were talking to me about mobile home parks. And I was like, what are you talking about? They're like, oh, they cash flow great. And I was like, yeah, but who wants to own a mobile home park? Now, like you say, everybody, they'd rather do a mobile home park than a multifamily project. They're just that appealing.
Yeah.
Now,
in a lot of ways, that kind of changed when Fannie and Freddie came into play. Around that time, they started financing parks, and they still won't finance every park. Most of everything we've done and most parks are still financed by local banks. But once you could get that 30-year fixed debt, well, that really changes the appeal of mobile home parks overall as an asset class. And over the past decade, up until 6-8 months ago, the economy was only going up, prices were only going up. So all these multifamily investors were really trying to chase yield and looking for something with those higher cap rates. So it drove a lot more people into the space.
Yeah, and the good thing I think about mobile home parks is there is a lot less growth in that as there is in multifamily. So multifamily, you can get, burned right out. Somebody can come in and create a nicer multifamily that changes. There's a quicker shift. With the mobile home parks, there's just not I think there's a lot of moratoriums on areas where you can't even build mobile home parks.
Absolutely. And so many of these parks, you have to really check with the government. Hey, I have these 5 vacant pads. Can I infill them or not? Hey, if a home gets moved out of here, can I bring a new home in place? And depending on the city, you may or may not be able to. And entire parks, I talk to owners several times a year who just sold their park to a developer or know that the land is only going to be useful to a developer because it's worth so much more than a mobile home park. There are some individuals out there developing new mobile home parks, but honestly, a lot of those are in Montana, in areas with these like $700 a month lot rents, because then they can sell these homes for like $150,000, $180,000 and still get that $700 a month lot rent. Like, that's not such a bad play. I see a lot less being developed where I am, right, in the Carolinas, that sort of area. And I've looked at this. A lot of times I have people come to me and they're like, hey, we should develop a mobile home park together. Like, honestly, if you don't have on your team people who can go in and create the water, the sewer, it doesn't make sense, because I have to put all that money into the dirt, but anybody else could buy that same land, put the same money into the dirt, but put townhouses, which are going to make a lot more money on the sale. So it doesn't make sense in some of these more rural areas to be building mobile home parks. It makes more sense to buy ones like you were talking about with the infrastructure in place and then infilling them.
Yeah, absolutely. Yeah, I think that one of the biggest keys, just like with commercial, is having the infrastructure there. That's what's the biggest advantage, where you can see a good upside. So when you're on water, sewer, if you run into something with a lagoon where you're self-treating, have a treatment plant, and that sounds like an absolute nightmare. But if you can tap into utilities, have utilities available, maybe that they just haven't transitioned to the utilities, where you could see a path, you might have a great value add on something like that. Well, that's amazing. Now, beyond that, you do other stuff besides mobile home parks. So we were discussing before we got going here that you were looking at some retail strip centers, and could you tell us a little bit about that and what you've gotten into with that?
Yeah. So, I'm under contract currently on a retail center in Georgia. It's 30% vacant. So it has some really good tenants in there, an urgent care center, physical therapy, and then it has some smaller like salons, but it does have a decent amount of vacancy, which it's on a very busy street with low vacancy overall. So right now, as part of our due diligence, right, we're testing the demand and testing how much we can get in rent to see if it makes sense to go in and within a year or two infill these extra spaces and therefore add a bunch of value to the asset. So in a lot of ways, it's commercial real estate. The details are different, but the strategy is the same. What can I do to increase the net operating income? What can I do to stabilize the asset so I can get the lowest cap rate on exit?
So walk us through a little bit testing demand. What does that look like? What exactly are you doing to test demand?
Putting up ads, especially on like Facebook Marketplace. We don't get as many from Crexy. Those tend to be more like brands, right? Those tend to be more national tenants that are kind of looking on Crexy and brokers. That's already been done. This asset has been marketed on Crexy with terrible pictures and not the best property manager, but it's been marketed for a while. So that's not where we're looking, is just to keep doing the same thing. So we're trying to go to Facebook Marketplace and really reach out to, I have a partner, Rinku, who's part of Invest Beyond Multifamily business that both of us know. So she has tenants who are nearby in other cities in Georgia. So she's reaching out to all of those tenants and saying, hey, I have this new potential asset. Are you looking to expand? Would this make sense for you? So we're really just trying to see, for the two of us, do we have a strategic advantage to infill, other than the fact that the property management has not been good at this asset? Is there something that we can bring to infill it quicker?
That's great. And so when you're looking at something that has, let's see, you said urgent care, physical therapists, salons, what type of complementing venues would you add to something like that? What are you guys searching for, looking for? What would something that match up well with that and fit into that retail strip center?
In this particular space, we need it to be a tenant who doesn't need a ton of exposure. So we looked at, well, one, a liquor store, because they could have kind of two pieces together. But funny enough, there's a law in Georgia that because there's a DUI school also in the center, the liquor store cannot come in there. So that's not going to work.
There you go.
Dag on it. That was her. That was her
That's
first
double
attempt.
dipping.
There's currently one that's being looked at. They do studies for pharmaceuticals and stuff like that. So they don't necessarily need this big street presence. They're not looking for street traffic. insurance companies, those sorts of things that can go in place. Not a restaurant, it's not built out for that, but if we could get the sort of medical research company in there, that would be a great fit for the physical therapy and the urgent care.
So what's the size of the retail strip center? How many square feet is it?
I think it's 17,000.
Okay. And you said there's about 30% vacant.
Yeah.
So we got about 5,000 feet to fill. And are the other tenants, are they on month to month, or are they in long-term leases?
So the two big tenants, the urgent care and the physical therapy, they're on long-term leases with good rents and CAM reimbursements. Then we have some of the tenants. So there are actually two different buildings side by side that we're buying. In the smaller building that's older, those are the month-to-month or really annual tenants. They're every year they renew their leases, and that's the DUI school, and then a couple of salons are in that space. And so we have about, I think, 1,500 square feet to fill in the smaller space, and then the rest is the in the bigger building.
Okay. So in the smaller, older building, I just want to run somebody through who could think this through and kind of understand how you approach something like this from a professional like you that's doing it. So when you're looking at something like this, you found the month-to-month rent, you have the two stable, which are great tenants, right? You have an urgent care and a physical therapy, which are, probably a lower cap rate that can help out the building. Then you have some short-term tenants that probably aren't adding much value and keeping the cap rate higher on the older building. So if we're looking at this to gain value just by potentially, starting to infill with better tenants and slowly making sure those new tenants come in and are paying their CAMs and properly leased up, getting longer term leases in place. This is how we start to add value, not doing anything with the building, just going in with a proper business plan and making money from the business plan aspect. What else do you look at? Are you guys going to fix up the exterior to try and draw rents up, or are you doing any other things?
The exterior actually looks pretty good. It's in good shape. So this one is all about infilling vacancy. So we expect to have more of those shorter term annual leases, maybe up to 2 or 3 years in the smaller building, right? Those don't have street visibility. That's the type of tenant that makes sense in there. It wouldn't even make sense if we went and put them on a 5-year lease, because if they stop paying, and we're going to want them out of there anyways, right? So those will be more of kind of the same. In the bigger building, that's where we'd really like to see a tenant that can help, like a liquor store that can go for a bit of a higher price per square foot for being able to go there, or this, research firm. Those would be good tenants that will put on 5-year or longer leases that can be at reasonable, price per square foot and just be a solid tenant to help with that cap rate balance. But when you have a 30% vacancy, it's pretty easy to get the value of the property up by infilling, with reasonable tenants.
Yeah, I mean, when she said 30% at first, that's the light goes off, and absolutely one of those. What are you going to do? Not much. You're just going to feel it. That's great.
That's great. Yeah, and you guys having a great plan, and it's amazing, to think. What holds some people back is, well, I'm going to buy this. I've only got 30%. We have 30% vacancy. I'm going to walk in and we're going to be in a bunch of trouble. What you guys are doing, you're working on locking it up, testing the market to see if there is demand for these vacancies. If it has been just mismarketed with these terrible pictures, as you say, if you guys can kind of strike a fire in it and see if you can get some action. But while you're in your due diligence period to see if it works, and then walk if it doesn't work. If it does work, then you're locking it up and going to have a new tenant probably in there when you're closing, which is amazing. That's an awesome way to look at it and think about it.
Ideally, yes. I would also call out, it's important to underwrite properly, right? So I can't underwrite as if we're going to go in and fill these right away. So my initial underwriting was we would have the existing vacancy for a full year. That was my baseline case. And then we can play around with, okay, what if it takes 2 years? What if it takes 6 months? Those are the things that we're starting to understand more in due diligence, that now I can go back and plug in and see how that impacts what we initially thought would be the case.
That's awesome. Yeah. So yeah, that's a great way to look at it. And so, yeah, I think that's what's getting a lot of people in trouble here is, too many rosy pictures for themselves when they were underwriting. And I understand that when the market was hot, everyone was just jumping and diving in. But now it seems like everyone's taking a lot more time. Things are on the market a little bit longer. And a lot of things that are going under contract are popping back up.
Well, with the rates where they are too. Yeah. It's just hard to get them to pencil.
And it's been so hard as rates continue going up for the past year, 15, 16 months. It's like you go under contracts, like even this one, I underwrote at 7.5. And then I'm like, okay, that's aggressive. That's that rate should be very doable. And then I'm getting back from bankers are like, oh no, we're actually going to be at 8.5 for this. I'm like, it just keeps getting worse and worse, like the longer you go.
Yeah. So the other thing I'm running into is they're saying, okay, yeah, we're 8.5. Maybe we even look at 9, and you're going to have to bring another 20% actually more down. So the rate's popping up and the percentage down is increasing. Like, how does this work? And then we're still having a lot of issues with sellers. They're just not with reality. They're not coming down to accompany all the increases from a buyer's point of view. I mean, there's still a gap, such a large gap that, hey, the value has to go down when we have the extra expenses for the money, and you have to bring more money down, makes these things a lot harder to work.
So much harder. And I get it, right? We have properties that we would consider selling, but I don't want to sell them right now because I don't need to, and I don't want to take a lower price for it. And that's where a lot of people are. They're like, hey, this is cash flowing me just fine. Why would I sell it right now when I don't have a problem with it? I don't need to sell. So the only people who are selling right now are people who are actually motivated to sell, and they're just obviously that's going to be a lower population than anybody who might be interested in selling that you'd have in a typical year.
And that looks a lot like the retail side as well, the supply and demand. So when people are like, I don't have to sell, I'm not going to sell, it's actually artificially propping up the prices of the ones that are looking to sell. So the supply and demand issue.
And the other thing that happens too, I think right now, is with the, increased down payment and the increased rate. So when I'm looking at something, let's say to build and develop, you have to bring so much more down. It's so much more expensive. And then those don't work. So then you have less new development, which makes these things even, have higher demand. In other words, so it's propping them up from that.
And then you also have the 1031 buyers and the people who don't really care as much, right? They're not full-time investors. This is not what they're doing. If they have to pay an extra $100,000, it doesn't matter to them. Whereas from our side, we're bringing in investors, right? We have to hit a certain return, which is just going to be a lot more challenging to compete with than your 1031 buyers anyway. So, it's a tough time all around right now, which is why we have to work extra hard for the deals that we do find.
Right. So tell us a little bit more. You mentioned that you're raising money. I know you also have, that we haven't mentioned, that you have another mobile home park that you're working under contract, as well as this retail center. And so you were doing a little capital raising. Could you kind of go through that and how you've set it up and what you're doing?
Yeah. So this one kind of fell in our laps. It's one of those situations where you get lucky, but you've worked really, really hard in the background to just get lucky. So we had this seller we've been talking to for a year. She wanted to sell, but it was in probate after her husband passed, and time goes on and catching up with her. And my husband called her last Monday because that was when they were scheduled to talk again. She'd finally gotten out of probate. She was going to have an appraiser go out and just see what the value of the property was. Okay, so he calls her, 8 days ago and says, okay, how are things going? How did the appraisal go? And she says, I'm not getting an appraisal anymore. I need to sell right now. It's a 20 lot park. She said, I had this guy who told me he would give me $100,000 for it. My husband's like, no. Hold on. This is a 20 lot park. Any broker would put this park on the market for $500,000. So she says she's going to get $100,000 from this guy. We're like, hold on, just wait. We can come down tomorrow and take a look at it. We'll pay you more than that. So kind of funny story. We told her we could pay her $259, but she heard $159. So we ended up going with a lower price even than we were going to pay her. And then she wanted us to like buy some golf cart and some nonsense. Anyway, so we're getting in 20 lot park for $180,000, which is just like unheard of, especially in Columbia, South Carolina. So it's a 2-week close though. It's a really quick close. So we brought in a handful of investors. It's actually full right now, but we brought in a handful of investors just to get us to close and do a little bit of turnaround and clean up. And then this was a debt structure. So we didn't do like, with the smaller deals and with such a quick turnaround, it's a little more challenging to do the full equity syndication. So we're doing a straight debt where they're getting 10% interest for a year or so until we end up refinancing out with a bank loan.
That's amazing. Yeah. And those are really what seems to be working right now. So I've been on a couple calls, and those debt deals really are the ones that you can kind of make pencil and work right now. Cause if people aren't able to do a lot of things, and there's a lot of money out there. So if they can turn and get a 10% on their money in a year or 2 years, it's better than putting it at a 4% money market account at the bank.
Exactly. I think a lot of people find debt deals a lot more attractive now than they did 2 or 3 years ago because the economy has changed, right? And so having a shorter term investment, getting that 10%, whereas it would be just sitting on the sidelines, has become a lot more attractive. And I think people understand a lot of investors had their money with a lot of these multifamily syndications. As you guys know very well, a lot of these multifamily syndications have stopped their distributions. And so investors who were passively investing and relying on the cash flow of these distributions that have stopped, like, oh, wait, maybe I should diversify and have some debt syndications paying me regularly, as well as these equity syndications that may give me a higher return overall, but not actually going to get that higher return for another 5 or 7 years. So kind of splitting that. So they have cash flow now and the higher returns.
Yeah, it's a good structure, and that's great that you've done that. And I think that there's going to be a growing demand for that and an increased demand. So as long as you guys keep making these follow-up calls right when you're supposed to, probably get some more going, and you'll increase and grow with it. But Amanda, it's been so great getting to find out more about what you're up to and what you guys have been doing. We really appreciate you coming on. We'd probably love to have you back, especially if you close on that retail deal and just tell us all about what you're doing.
Yeah.
Absolutely. Thank you guys for having me. This was great.
Yeah. And Amanda, if somebody wants to reach out to you or connect with you, and maybe they want to give you some money for another debt deal, how do they reach out to you?
Our website is voyageinvesting.com. So you can hop over there and join our investor circle. That's how you get in the know about any future offerings that we have. And feel free to come connect with me on LinkedIn, Amanda Cruz.
Yeah, absolutely, Amanda. And the other thing I would tell anybody that jumps onto her website and does something, Amanda does a great little weekly newsletter she puts out, very informative, and she is very consistent on it. There are some people that it's just spam, but yours I actually read a lot of times. So, very good quality stuff. So yeah, definitely reach out and jump on her website and get on her list. Yeah, Amanda, thanks so much for joining us.
Thanks, Amanda.
Thank you guys.
All right, have a great day.